Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, next one. Next on the hit parade of potential problems, China. We know China is the big dog of growth, and we look to China now really to drive global growth, and they have. And China really has stepped up and surprised us, to tell you the truth, in the amount of growth that they've been able to create, given the relative lack of demand in the background. But if you look at the numbers, China has effectively, over the last 18 months, from a credit standpoint, put about 50% of the size of their economy into their economy in terms of credit, direct bank loans, direct subsidies from the government into state-owned industries and local and state governments. A massive amount of credit has gone into the system. China officially says their debt to GDP is something like 25%. But if you count it the way the Western economies tend to count things, some people say it's way up there, 80 to 100%. Not going to argue those numbers. It doesn't really matter. But what matters is they've made a massive amount, and I think the bottom line is this: a massive amount of investment in order to keep the music playing. They've hit their GDP number, but they've hit it by doing the same thing that's kept them on track in the past in a world where there was massive global demand, and that's by increasing manufacturing capacity in a very, very big way. A lot of the money, as we know, has gone into real estate in a huge way. Mr. Chanos, who's a major hedge fund investor, has been very public on this, talking about this. The incredible amount of money they've put into real estate and the relative overcapacity. The number, I think he says, if you were to take all the current Chinese industrial properties and create little cubicles, you could have a 5x5 or a 6x6 cubicle for every man, woman, and child in China. There's a lot of people in China, so that analogy gives you an idea of how much capacity there's been in building in China. China knows they have a problem. The state and local governments have been involved in this huge building capacity. Really, they've created their own type of off-balance sheet type of investment vehicles. They got the U.S. investment banks, which they used to be U.S. investment banks, which are now gone. The same type of off-balance sheet vehicles have funded this growth in real estate, and it's been very much a big pyramid game. And the trouble is, this has to stop at some point. China is very concerned about it. You're finally starting to see that stuff in the news. So that's the idea of where this problem may come, if it happens in terms of a break. But needless to say, everybody's still very happy about growth in China, and it's driving commodities, and that growth is real. I mean, China demand for commodities is real, cement, steel, whatever. But the fact is, in terms of even in those industries at this point, they have massive overcapacity in steel, cement, aluminum, and they'll admit it. Just massive overinvestment in a lot of the key industries, and you're seeing corporate profits wafer thin, and most of them aren't profitable. But that's okay if you're a major Chinese company, because effectively your cost of capital is free, because you're a strategic industry and ultimately you're owned by the state. But that creates, from an economic standpoint, sooner or later, that has to come back to bite you. It's a massive waste or inefficiency of capital and dislocation in the marketplace. So we're not sure they can get through this because of the fact that we're not sure that the U.S. consumer is going to grow the way it did. I just showed you what's happening in Europe, and it's doubtful you're going to see any upsized growth surprise from the consumers in Europe. If U.S. employment doesn't rebound, we think this China squeeze gets greater and greater and greater. This is why there's so much pressure, or at least so much fight in China on this currency question. They are definitely afraid that any movement on the currency, even a small movement, will nip exports, and at the margin, that could hurt them in a very, very big way. So there's a lot of concern here, and guess what? The stock market and all the commodity currencies and all these commodity moves have predicated on China keeping this music playing. It's a very, very risky bet. As I said, a lot of people will say that, well, we saw China in this problem before. They had overcapacity. They had major bank loans, non-performing loans, and it looked like they were going to go belly up. But the difference is back then it was a global environment of very, very strong growth in the mid-2000s. Pretty strong up cycle in the global economy. The U.S. consumer was buying stuff like a drunken sailor. It was the perfect storm of free credit in the world. That has all changed, and that's why this situation now is very, very different and not analogous to what it was before. In this whole currency question, which is you're seeing the fight against the U.S. and China. I mean, anybody with a pulse knows that China's currency is undervalued. The question is by how much. Of course, the numbers are 10%, 20% to off the board, 50, 70, whatever. But the U.S., because of the fact that we're seeing, number one, the whole change in the regulatory environment. Two, the shift from capital to labor in terms of the outlook. This idea of China manipulating their currency becomes a much more bigger political wedge than it ever has before. So the reality is, if China doesn't step up and just make some concession in here, we definitely think the protectionist pressures are going to continue to build, and they're already building in a very big way. And for the first time, really, in the cycle that we've seen, even the Asian bloc, the Asian bloc currencies or countries actually start to complain about China. They've been afraid to in the past, but they're complaining now because China is subsidizing so much of its exports and trying to push this adjustment that China should be taken domestically onto its export partners, and it's something that's creating the trade tensions. The West really only has one choice in order to try and stop this, and it's through protectionism, or at least that's the way they see their only choice. There are other things to unleash the U.S. entrepreneur, but that's a whole change back from the direction we're going, so we don't see that happening. So we see this protectionist pressure rising more and more, and if it comes along with the helps to pop this bubble, it's trouble. Just to go through this, and I think I've blabbed too long, so let me quicken this up. I won't go through all of this, but I just wanted to show you this we put this together, a couple months ago, hopefully to help you understand, what's going on here. As we said, since demand has gone out of the world from the credit crunch, China's government had to step in and provide explicit stimulus, explicit and implicit. They basically own the banks, so it's a conduit really of the central committee, these banks. It doesn't mean their bad loans are going to be painless. Ultimately, it'll come back and hit the Chinese consumer, these non-performing loans. We won't get into it gets a little bit esoteric, but non-performing loans in China in this environment without growth means that it suppresses Chinese consumer demand even more. So there's the trouble. But what we've seen is a massive amount of capital investment now at about 50% of GDP. That's really off the charts of any countries in the world to have that much gross fixed capital investment relative to GDP. And China already had a high gross fixed capital investment going into this. It's been even greater, which shows that they haven't put the money into consumer demand to have their own domestic demand get them out of this problem. They're betting on a rebound in global demand. So that's problem number one. Problem number two, as I said, they get seamless cost of capital from the government, goes into the Chinese companies, and it forces this pressure on trade. So, as I said, they're not taking the adjustment domestically. They're trying to force the trading partners to take this adjustment that China should be taking.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.